Welcome to the 3 in 10 podcast. I'm Scott Slayton, partner and chief strategist at Capital Creek Partners. In each episode, I'll give my brief perspective on 3 things we think market participants need to know this week, and we get it all done in 10 minutes or less. For additional resources and analysis, please visit our website at capitalcreek.com. Welcome to the 3 in 10 podcast for Friday, June 19th, 2026. We are recording at 10:30 a.m. Eastern Daylight Time. This is episode number 58, and I am your host, Scott T. Slayton. Now, the starting lineup. Thoughts on the 14-point plan to end the U.S.-Iran war. We read through it, and we have some thoughts. Number 2, the June Fed meeting, a clear focus on delivering price stability. And number 3, retail sales, control group retail sales, reveal a resilient consumer. So back to the 14-point plan. The MOU was signed on Wednesday, and it only took 48 hours for Israel and Lebanon to pressure the ceasefire and the deal. We read this 14-point memorandum of understanding, and we found it to be very reasonable, although somewhat shaded toward Iranian interests. But it's a decent starting point. Point number 4 is crucial in our opinion, and it's crucial for financial markets. The Strait of Hormuz will be fully opened in 30 days, and U.S. forces will need to leave the Persian Gulf region or Iranian waters within 30 days of the final agreement. Point number 6 was a surprise to us. $300 billion of reconstruction and economic rebuilding funds for Iran. I think that's key to long-term stability in the entire region. If somehow we can get Iran back into the international community and a prosperous nation again, I think the prospects of long-term peace in that region go up dramatically. Number 7, ending of all sanctions on Iran. The key to peace is prosperity. And if Iran can get going again as a reasonable member of the international community, I think that's good for everybody. That's a long shot, but it's still a hope. Point number 9, maintain the status quo on Iran's nuclear program. No wonder the Republican senators in Israel are so disappointed. What did we get out of this? Just the status quo on Iran's nuclear program? Did we really need to go to war for that? I think everybody's disappointed by that, but it's going to have to take a lot of give to end this war. Now, Iran's frozen funds and assets will be made fully available as per point number 11. That's a huge win for Iran. This amounts to $100 to $120 billion in assets. When you add that to the 300 in reconstruction, that's $400 to $420 billion for Iran to get going again. That's a lot of money. So a deal this complex will be a long, hard road in our opinion. 60 days is just simply not realistic. A deal this complex is not going to get done in 60 days. It would take, under normal conditions, 6 to 9 to 12 months to get a deal like this done. And so we do not believe this 60 days is even remotely realistic. The 14-point MOU favors Iranian interests. It's pretty clear. And the final deal probably will too. But all politics aside, and who cares who wins and who loses, the market cares. The market cares about the free flow of petroleum products, fertilizers, and gases through the Strait of Hormuz. So this preliminary deal, in our opinion, looks to achieve that, and that is bullish for equities and bullish for bonds. This deal is bearish for oil, it's bearish for gold, and it's bearish for commodities, where we admittedly are overweight, and we've got to rethink our thesis there in light of this. Now, number 2, the June Fed meeting. The new Warsh Fed came out of the gates hawkishly. The statement was terse, and it was focused on price stability. the delivery of price stability. There was no mention at all in the statement about maximum employment. So we've seen this before. We remember Janet Yellen was overly focused or heavily tilted toward maximum employment at the expense of price stability. Well, we see the Warsh Fed being the exact opposite, focused on delivering price stability after not having it for 6 years at the expense of maximum employment. Now, 9 dots indicated a hike is coming as the next move. The median dot rose to 3.8%, where the median Fed funds rate today is 363. 380 is about 3/4 of a hike. So the summary of economic projections highlight the core PCE forecast for this year, 2026, rose from 2.7 to 3.3. That is an extraordinary increase at the midway point of the year. So obviously the forecast was way off. 27 is forecast to be 2.5%. 28 is forecast to be 2.1%. We highly doubt those numbers. It's going to take a while to return to the target, and the Fed has not been very accurate at forecasting the out years. For the last 5 years, they've missed the out years massively to the upside. Now, Warsh was honest, saying the Fed can't forecast inflation. We know that. The market knows that. If they could, they wouldn't have missed their target for 6 years in a row in one direction, all to the upside. However, I was struck by how clear, unequivocal, and determined Warsh was to deliver on price stability. I went back and counted in the press conference. Warsh mentioned delivering on price stability 8 separate times in the presser. And we believe him. We agree with him that it is the Fed's decision whether they want to deliver on price stability or not. And the Powell Fed clearly did not really focus on that, or they would have hit the target. Now, we believe Warsh, we wrote about this in our Punch Bowl piece a couple of weeks ago, that Warsh was a hawk in dove's clothing. Well, he revealed his true colors early, in our opinion. We were surprised, I think pleasantly surprised. And we were impressed overall with his debut. Reforms are clearly needed to deliver on price stability, and Warsh appears ready to work on those and deliver them. So a hard money central banker and an adroit politician now occupies the chair of the Federal Reserve. That is a powerful combination. Markets may struggle in the near term to adjust to this new regime, but longer term, we think it's a major positive for financial markets and also for U.S. consumers who have been overly taxed by inflation for the last 6 years. Now, on to our final topic, retail sales, and we focus on the control group. And here we see a resilient consumer. Nominal retail sales surprised to the upside in May. The control group consists of retail sales ex food services, so restaurants, auto dealers, building materials providers, and gasoline stations. A better measure, a higher signal to noise ratio by weeding out these very volatile categories. So control group was up 0.07% versus a 0.04% estimate and 0.05 in the prior month of April. So consumers are willing to keep on spending despite the war, despite high energy prices, despite tariffs, despite fears of future employment caused by AI, despite very low, generationally low consumer confidence. Consumers are spending. So watch what they do, not what they say. April retail sales were revised higher, and May was the 5th consecutive month of increased retail sales. So we expect a positive revision, or this will amount to a positive input into second quarter GDP. The report implies upside to second quarter GDP forecasts, and frankly, I think it implies upside to second quarter earnings, following on the heels of the incredibly robust first quarter. So the consumer remains the backbone of the long economic expansion dating all the way back to 2010, albeit with the brief COVID period, which was a technical recession. But this expansion has gone on for 16 years outside of that brief COVID downturn. Strong demand argues that inflation risks remain significant, And this ties into the Fed, where the hawks now have the ball and are on offense. This also supports our punch bowl thesis that accommodation needs removal, not to be mean, but because it will help elongate the economic expansion and help return inflation to the 2% target. So do the work, endure the fog of war, and have investment prudence.
The information in this podcast is educational and general in nature and does not take into consideration your personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategy or investment may be suitable for you, consult the appropriate qualified professional before making any final decision.